This episode is brought to you by SmartVestor. Connect with an investing pro near you at RamseySolutions.com/SmartVestor.
What the heck is a mutual fund?
Wouldn't you like to know? Well,
I
Jade
would.
knows, but for the benefit of the group, a lot of people go, okay, I know Dave talks about that a lot, the good growth stock mutual funds, right?
Right.
That's a classic Dave line, but what is actually going on there? So let's talk about this. Mutual funds are investment vehicles that pool money from multiple investors, aka you,
And me.
and Jade, and me, to purchase a diversified portfolio of stocks, bonds, or other securities. So how do they work? So you're buying shares of a collective portfolio.
Ooh,
so you're buying a tiny
wait,
piece.
George.
A share.
George. I heard equities. I heard securities. I heard.
I'm pushing my glasses up for you.
Make it. Put it
Okay.
on the bottom shelf for us.
All right, so shares are tiny pieces of a company, tiny pieces of ownership. So mutual fund, let's say there's 90 to 200 companies within this one fund. And so when you buy a piece of the fund, you're really buying a piece of these 200 companies.
Amazing.
Got that?
Yeah.
So investors, we all benefit from this diversification because we all know, oh my gosh, Elon burped and Tesla stock went down 40%.
Right.
Well, we don't have to worry about that when there's 199 other stocks from other companies to balance it out.
So when you say that, you could have a fund that's got everything from Procter and Gamble to Pfizer to Coca-Cola
Apple,
to
Home
Apple,
Depot.
all of that, all of those different stocks in one fund.
Exactly. So the benefits here, instant diversification. You have lower costs because trading single stocks can get expensive. Mutual funds make it really affordable to invest in a range of stocks without all these transaction fees because you're not doing these little nickel and diming transactions. And with an actively managed mutual fund, which is a lot of the time what we're talking about on this show, there's a team of investment experts that have come together to decide which stock should go in here. And they're actively going, hey, should this one move out? Should this one move in?
And what are they trying to do when they do that?
Well, they're trying to get the best return for us, the investors.
Yes.
So that's the goal. So when you hear about, a few types of mutual funds, for example, good growth stock funds. So what that
Yes.
means is these are equities. They're stocks. These are not bonds. They're meant to grow. So we say good growth stock. These are companies that we expect to see some
Growing.
growth from.
That's right.
When you hear the word index fund, well, that's really just a type of mutual fund. And what people are generally referring to is a passively managed mutual fund. So nobody's deciding what's in the fund. It's just taking the top 500 companies. So an S&P 500 index fund is just going to take the top 500 companies and buy those stocks.
That's right. And you could have different indexes. Yes. So
Yes.
we talk about the S&P 500 a lot. That's kind of like the holy grail of indexes that people follow, but you might have heard of others like NASDAQ.
Dow Jones.
Dow Jones.
See the ticker
Yeah.
symbols up. So they're just different, pools of companies.
That's
Some
right.
are tech focused, some are other healthcare focused. And then you've got bond funds, and these are really fixed income. These are for people who don't like the volatility of the market. They just want something stable. So these invest in corporate or government bonds. There's regular interest income, lower volatility. So some people like that.
This is just getting nerdier and nerdier. I'm liking it.
I'm trying to put it on the bottom shelf so that in 5 minutes we can all go, great, we learned it.
Yeah.
We can move on. And then lastly, a money market fund. So you hear about that? That's almost like a high yield savings account.
Basically.
Where it's just sort of sitting short-term debt instruments, but it's high liquidity, meaning you can take that money out and you're not going to worry that it's going to go up and down. It's just
That's
going to
right.
sort of sit there making a little bit of interest like a savings account.
Love that. So, George, how do mutual funds make money? I mean, you told us what they are, but technically, how are they making money? Are we making money every time the company makes money, or how does that work?
Yeah, so as the company stock share value goes up, we make money. And sometimes that's paid out in a dividend. So think of that like profit sharing. The company made some profit. They're going to reward the shareholders for holding on to these stocks for the long term by giving them a little bit of money.
Love that.
Or it can be reinvested. And so that's what we do in our retirement accounts. We're not getting dividends off of that. We're just reinvesting the growth.
That's right.
And that's what creates this amazing compound growth. And the other way is capital gains. So when you sell it for a higher price, if I buy Apple stock at $100 and 5 years later it's $150, well, I made $50 per share.
That's great.
So that's another way to make money if I sell that. And now you don't want to do that in a retirement account, but unless you're of age to
That's
retire.
true. That's true.
But
That's
if you're under 60, you
Hold
want to
it.
just hang on. But if it's in a taxable brokerage account, meaning it's non-retirement, you would sell and you would have capital gains tax, either short-term or long-term, depending if you've held it for a year or longer.
So, George, I hear Dave and you guys and myself all the time. We talk about the 4 different types. Can you go through those so that people know once and for all what the heck we're talking about?
So you'll hear Dave say, growth and income, growth, aggressive growth, and international. Here's what you might see that listed as if you're looking at your 401k, for example. You might see it listed as large cap. That would be your growth and income. These are large, boring, stable companies like your Home Depots. They're out there. They're not going to be skyrocketing. They're not like innovating in crazy ways, but
consistently,
they're stable. You need these as the foundation. Then you have the medium cap, which is going to be your growth funds. So these are medium to large companies. Then you have small cap. These would be considered your aggressive growth companies like small tech startups. And those are going to be the wild child. It's going to go
really
way
high,
up, real low.
That's right.
And then finally, international. So you want to have this as a hedge. Think like BMW, LG, Samsung. These are international companies. And what we found, Jade, when the U.S. market just took a dip like it did recently, what happened? International funds
So they balance each other out.
So it balanced out. And people have said, well, Dave, international funds have been underperforming the U.S. stock market for a long time. Should we switch that up? And we just saw a great example of why Dave keeps international as a quarter. So when you talk about investing in your retirement account, we recommend just a quarter in each, 1/4. So 25% in that large cap, 25% medium, 25% small, 25% international. And if you just choose those 4 funds in your 401k that have a long track record, and have a solid return, you're going to be okay. It's as simple as that.
That's right.
You don't need to overcomplicate it.
I love that. I feel like you made it very clear for us. This is good.
I tried. And we do have there's some great next steps you can take. And number 1 is connecting with a SmartVestor Pro. So these are financial advisors that can teach you all of this stuff in depth so that you understand what you're doing. They're not making decisions for you. The ball is in your court, but you need to know what's going on with your investments. So you can reach out, connect with a SmartVestor Pro, RamseySolutions.com/SmartVestor, or click the link in the description if you're listening on YouTube or podcast.
Very, very good. I like it.
Painless.
This is very, very helpful stuff. All right, George.
I'm the Miss Rachel of mutual funds. I try to just keep the cookies on the bottom shelf.
You said the Miss Rachel?
Yeah, that's for kids.
Oh, I was
You're
going to say.
beyond that phase. I'm in the Miss Rachel phase right now.
Oh, so this is like Coco Melon, that kind of deal?
Yes.
Got you.
Thanks for tuning in to Ramsey Everyday Millionaires. Need help with your investments? Connect with a SmartVestor Pro at RamseySolutions.com/SmartVestor or click the link in the show notes. Ramsey Solutions is a paid non-client promoter of participating pros. Learn more at RamseySolutions.com/SmartVestor.